Good morning, everyone, and welcome to the Ankerstar Wealth Market Update. I'm your host, Steve Ankerstar. Allison has the day off. She's actually taking her final exam of high school today. And then if you didn't know, she'll be off to the University of Alabama in the fall. So very excited for her. And if the schedule works out, she's still going to host the morning show. So pretty excited about that. For today's topics, we're going to be talking about the Fed rate hike yesterday of 50 basis points. And of course, the market shot higher after that. We're also going to talk about what an overall raise in the interest rates means for the consumer. So kind of separate it from the market, talk about how it affects things in our daily lives. And lastly, there was really a negative labor number that came in this morning that I don't fully understand, to be honest, but I will explain to you what I do understand of it and explain that that's going to be a pretty significant headwind today. So we shall see. Before we begin, as reminders, the financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. All right, let's take a look at the market yesterday. First of all, I have my flight suit on for the first time in a long time. For those that didn't know, I had shoulder surgery 3.5 weeks ago. So now I'm finally at the point where I don't have to wear the brace all the time and can actually move my arms and get in and out of a flight suit. So pretty excited to be back in that for the morning show. All right, what you're looking at here is the TD Ameritrade Think Pipes S&P 500 chart. I bring this up on occasion when I want to talk market stuff. This is a 1 year left to right. You saw the big run up peaking at the end of the year, and then obviously the volatility that we've had here in 2022. And that has been the story. You have inflation as the disease raging along. You have the Fed raising rates as the cure. And again, the cure could be worse than the disease and throw us in a recession. Those are the big concerns. And the Ukraine-Russia conflict is not going away. I thought it was going to wrap up here in May. Well, it's May, and there's nobody really talking about wrapping anything up. So if it continues on, through the summer, that's going to be a pretty significant drain over there for both sides. Again, fighting the war through the summer. But back to the move we had up yesterday, the move that we had up in the market yesterday. Excuse me. Pretty significant. Now, it was kind of just a little bit of an up day until the announcement of the 50 basis point rate hike, which was expected. And then Steve Leisman from CNBC asked the question, are you entertaining more than 50 basis point rate hikes in the future? And Chairman Powell was pretty unequivocal when he said, no, they're not. So that kind of settled things down. It's like, okay, well, if the Fed's not going to do 50 basis point or more than 50 basis points, everybody's like, okay, we can handle that. We can price that in, and off we go. So the market celebrated that. Now, as a reminder, the Fed can change its mind. It has a job to do. It doesn't, and pleasing reporters or you or I is not one of them. So they could change their mind on that. And they also, they don't have to wait for another 6 weeks to raise rates. They could do a rate hike in between meetings. Now that's uncommon, and it's kind of considered a emergency, break glass in case of sort of thing. And that would spook the markets, of course, if that happened. But they could. So, he's given his best information, like all of us do every day in our different professions. We don't have crystal balls, right? But we give you the best information we have at the time, of course. But the market celebrated that yesterday. And then, of course, today, starting to sell off a little bit. So let's go over to CNBC and kind of see where we are for the futures today. And they're in the red. And now they were in the red even before this labor number came out. So here you go. Here's CNBC. Talk about that labor number here in a minute. So we can just go back to the futures here. So almost down 1% in the NASDAQ, 0.5% in the Dow, 0.75% or closer to 2/3 actually in the S&P. But really, whenever you see a big move like we saw off the other chart, sometimes you'll have a retracement, and those are moves up or down. You just have this huge move, and then the next day it walks it back a little bit. When you talk about some of the biggest gains we've had since 2020 in single day gains, if you will, I was looking for the exact numbers there. It's buried in here somewhere. But yeah, overall, we had this big, the relief rally, if you will, because now we think, okay, things are under control. I was explaining this yesterday to a client. of clients celebrate certainty. They don't kind of care how bad the information is, but if it's accurate, then they can price it in and you can move on. So there's like all this uncertainty out there. And so if you considered it conceptually as a big ball, right? The bigger the ball of uncertainty, the more the stock market's going to go down. And then as more unknowns become knowns, you shrink this down to where there's always going to be at least a little uncertainty, but you shrink that down pretty significantly. And that's when things, people can really allocate their capital off of more knowns and feel more comfortable taking risk, which means buying, which means market goes higher. So that's kind of what we're seeing here, a little bit of a retracement from yesterday. What does this 0.5 point rate hike mean for your money? Most people immediately think of the mortgage industry. So if you haven't refied, now is not the time, right? You had a decade to do that. Hopefully you didn't sleep through that. But when you look at where are rates, historically, in the 80s, we're up here almost 20%. It's kind of crazy, right? So but here we had the big financial crisis, of course, brought things to zero. And then we tried to walk back out of that in 2015, up through 2018, and then had to go back to zero. When we talk about volatility in the markets, 2015, 2018, 2020, that was COVID. And now 2022, 3 of the 4 of those are the Fed increasing rates, right? So we've seen this movie. That's why I'm very comfortable buying in here. So, I'm not saying it's the absolute bottom, but I'm very comfortable putting capital to work where we are. Okay, so back to answering the question of historically, it's still pretty cheap for money. So, but credit cards, mortgages, auto loans, student debt, and savings accounts are all going to be affected by this. Now, is your bank going to immediately pass on the savings to you in your savings account? Heck no, they're going to only pay what they have to pay, right? Are the credit cards going to immediately raise rates because they can and pass on the higher interest rate to you? Absolutely, they will. Mortgages, that the 10-year, the 30-year went from, and I think the exact numbers are down here at the bottom, went from, I want to say 3.11 at the end of December, 4.5 months ago. And it just hit 5.55 this week. It'll be at 6 by next week because of this 50. Tack on another 0.5%, right? Might be at 6 today. I haven't even looked, but certainly by next week, which is, a whopping day and a half, right? So it's a game changer. And when you look at affordability of houses and all of the income ratios and things that unless you're a cash buyer, good for you. But if you're using a mortgage as leverage to get into a bigger home than you can pay cash for, whether it's an investment or just a place to live, either way, it's getting more expensive. The fixed rate loan has been very popular now for about a decade. Before that, ARMs were very popular. Again, the adjustable rate mortgages, just, buyer beware, right? Because you get a teaser rate for 3 to 5 years. If you sign up for that, you still have to remember what the rest of the contract says, right? And people are like, well, I'm going to move in 3 years. Okay. We all think we know what we're going to do. We don't, we just think we do, right? Because I don't know, right? Things change, things happen. So those have come back to bite a lot of people, but certainly now, as the financial planner side of me, I really do actually have to now consider an ARM and whether that's right for the individuals. And if it's a high probability they are going to move in 3 years, then maybe an ARM's right. And it's going to kill me to say that, but I have to do the math for them and report the numbers, not my personal opinion. And I'll throw a personal opinion on the side, but those could be players. Now, if you're sitting out there, if you did a HELOC, maybe you put in a swimming pool or some home improvements while money was cheap, you got a nice cheap rate. However, those tend to adjust right away. So if you don't know what's going on, I would, log in, look at your statement, see what the interest rate is. Sometimes they bury that and it's kind of BS. That's an opinion. You may actually have to make a phone call to figure out what interest rate you're paying, which annoys me. But yeah, they don't make it quite as obvious as a credit card, which has to, by law, put this big bold number out there to let you know what you're paying. Last one, as far as credit cards, again, I love credit cards. I use them for convenience and I pay them off every month. I wasn't always in that situation. I've been cash flow troubled before to where I had to carry it. And you're right, it's expensive if you're carrying it month to month. I think they said 16.6 was the average nationwide right now, and that could jump up to 18 is what here it is, 16% just over. And then 18.5 by the end of the year, which would be an all-time record. That's one guy's guess, but he's the industry analyst, so give him credence for what he thinks there. But yeah, 18.5%, that obviously is crippling debt for those that are in a situation where they have to go down that road. So take a look if you have debt out there, or leverage, however you want to call it. Just take a look at the interest rates you have, see if they're adjusting or they're not, because things are on the move. So you just need to pay attention a little bit to it. Okay, last thing I want to talk about today: labor productivity fell 7.5% in the first quarter. The fastest rate fall is what that meant. I looked since 1947. It's just like, oh crap, here's a 70-year number. So it's just like, okay, what does this mean? So it's the decline in labor. So I'm sorry, the forecast was the productivity was a decline, and then labor costs increases, and those are somehow melded together to get to the 7.5% number. I'll refresh this and see if there's more to the article. There is now. But so I don't really hang my hat on this. This is not, I like the unemployment numbers. It kind of normally tells them the better picture. But what we have right now is labor costs on the rise, which is good for, the citizens of the United States, is that they're getting paid more for the jobs that they're doing and the services that they're providing or products they're making. And they're able to live a better life or keep pace with inflation, right? So that's a good thing from the masses out there. From an investor / owner perspective, obviously a labor cost is just a cost you can't get rid of, right? You have to pay your workers for what they're worth. So it does get into and affect your financials. So we know the great resignations going on. It's like, where are all the workers? Well, they're choosing either not to work because they're not getting paid what they think they should, or they are getting paid what they should somewhere else, just not at the restaurant that can't keep staff around. So it's forcing a lot of people to make a lot of decisions out there, both on the working end and in the hiring end as well. But overall, when you get a big negative number like that, I think that's going to be a headwind overall to the market today. So I wouldn't be surprised. Here we are sitting in the red. We haven't moved much in the 10 minutes that I've been talking. But yeah, I don't expect the market to continue to scream higher like it was yesterday. But I don't really think it's going to fall the bottom out of it either and retrace all of that. So overall, I think it'll be a muted day while people digest the information from the Fed. So with that, thank you so much for your questions out there this morning. Please submit them every day through either social media or the VIP services at AnkerstarWealth.com email. That's all we have for today's show. I'm Steve Ankerstar, and we will see you back tomorrow morning. Bye.